Now, let's assume the unthinkable. What if the Federal Reserve has already tightened too much? Monetary policy is like steering a massive ship. You turn the wheel today, but the ship changes direction months later. That lag makes central banking incredibly dangerous during uncertain times. In 2026, some economists believe we're still feeling the delayed effects of earlier rate hikes. Credit conditions are tighter than headlines suggest. Regional banks remain cautious. Venture funding has cooled. Startups are cutting burn rates. Commercial real estate faces pressure as refinancing costs rise. These are not loud signals. They're quiet ones. Recessions rarely begin with headlines that scream collapse. They begin with subtle shifts, tightening credit, slower hiring, declining overtime hours. The labor market has been the strongest pillar of the U.S. economy, but cracks may form gradually. If businesses sense slower consumer demand, hiring slows. Wage growth moderates, household spending contracts. And once consumer spending contracts meaningfully, GDP follows. The risk of over-tightening lies in feedback loops. High rates gives lower spending, gives lower earnings, gives layoffs, gives lower spending. Again, the Fed's biggest fear is inflation resurgence. But markets fear something else: liquidity withdrawal. Liquidity fuels asset prices. During the ultra-low rate years, money was abundant. Risk assets soared. Crypto boomed. Tech valuations exploded. Now liquidity is restrained. If a recession forms, under tight liquidity conditions, markets could experience sharp corrections. This is why investors watch bond markets closely. Treasury yields signal expectations. If long-term yields fall sharply while short-term rates remain high, markets are anticipating slowdown. The Fed, however, doesn't want markets to dictate policy. It wants data confirmation. That another important dynamic is household debt composition. Many homeowners locked in low mortgage rates years ago. That cushion provides some stability. But new buyers face far higher costs. Auto loans and credit cards are more sensitive to current rates. If delinquencies rise, lenders tighten further. That tightening spreads through the economy like a chain reaction. The political dimension also matters. Election cycles often pressure policymakers indirectly. The Fed is independent, but public perception influences credibility. If recession fears grow, pressure to cut rates increases. Yet cutting prematurely could damage long-term stability. So what would a 2026 recession look like? Likely not 2008-level financial collapse. Banks are better capitalized. Household leverage isn't as extreme. But a growth slowdown, rising unemployment toward 5 to 6%, falling home prices in overheated regions, and a stock market correction of 15 to 25% is plausible under stress. In that environment, the Fed would pivot rapidly. Rate cuts would accelerate. Liquidity facilities could reopen. Markets would rally on expectations of easing, even before economic recovery begins. Ironically, markets often recover before recessions officially end. So the real question for investors isn't whether a recession happens, it's whether you're positioned for volatility. Defensive sectors typically outperform during slowdowns. Utilities, healthcare, consumer staples, cash reserves gain strategic importance. Short-term treasury yields remain attractive when rates are elevated. Meanwhile, long-term investors may view downturns as opportunity. Historically, recessions reset excesses. They purge inefficient capital allocation. They stabilize inflation. They create new innovation cycles. If the Fed is preparing for recession, it may be preparing for economic renewal as well, but preparation doesn't eliminate pain. Unemployment hurts households. Small businesses suffer. Consumer confidence weakens. The Fed's challenge is precision, slowing enough to control inflation, but not so much that momentum collapses. And precision is difficult in a globalized, highly leveraged, psychologically sensitive economy. So is the Fed secretly preparing for a 2026 recession? Maybe not secretly, maybe strategically, or maybe cautiously reacting to forces it cannot fully control. Markets want certainty. Central banks operate in probabilities. The coming months will reveal whether this tightrope walk ends in soft landing or stumble. And if history teaches anything, it's this: economic cycles never disappear. They evolve. The only question is how prepared you are when they turn. What if the biggest risk to your money in 2026 isn't inflation, but the quiet decisions being made behind closed doors at the Federal Reserve? For months, Americans have been told the economy is resilient. Job numbers look stable. Consumer spending hasn't collapsed. The stock market, despite volatility, hasn't crashed. But beneath the surface, something feels different. Interest rates remain elevated. Borrowing costs are tight. Corporate debt is heavy. And the central bank continues to move cautiously, almost strategically, slow. The real question investors are asking isn't whether a recession is coming, it's whether the Fed is deliberately engineering one. To understand this, we need to understand the role of the Federal Reserve. Its mandate is simple on paper: control inflation and maintain maximum employment. But in practice, those two goals often collide. When inflation runs hot, the Fed raises interest rates. Higher rates slow borrowing. Slower borrowing cools business expansion. Cooling business expansion can increase unemployment, and increased unemployment can tip an economy into recession. In recent years, inflation surged to levels not seen in decades. The Fed responded with one of the fastest rate hiking cycles in modern history. That aggressive tightening successfully cooled inflation, but it also raised concerns about long-term economic strain. Now in 2026, rates remain restrictive. The central bank has paused major changes, waiting for clearer data. This pause has sparked speculation. Is this stability? Or is it the calm before contraction? High interest rates do more than just increase mortgage payments. They affect everything. Housing slows first. When mortgage rates climb, affordability collapses. Fewer buyers enter the market. Sellers hold back. Construction slows. Real estate, a massive driver of U.S. economic activity, begins to cool. Historically, housing downturns often precede broader recessions. Then comes corporate pressure. Companies that borrowed heavily during low-rate years now face refinancing at higher costs. Debt servicing eats into profits. Hiring freezes begin. Layoffs quietly increase. Earnings forecasts get revised downward. Consumers feel it next. Credit card balances hit record highs. Auto loans stretch longer. Delinquencies tick upward. When consumers tighten spending, corporate revenues follow. This is the cycle policymakers know well. The controversial question is whether the Fed is willing to accept or even intentionally trigger a mild recession to permanently eliminate inflation risks. From a central banker's perspective, a short-term recession can sometimes be considered necessary pain. Inflation, if left unchecked, erodes purchasing power, destabilizes markets, and creates long-term damage. A controlled slowdown may prevent a more severe crisis later. This strategy isn't new. Historically, central banks have tightened policy until economic cracks appear. They wait for inflation to convincingly return to target levels before easing aggressively. The risk? They may over-tighten. Many analysts now debate whether we are already in the late stages of that tightening cycle. The yield curve has shown inversion patterns in recent years, a classic recession signal. Corporate defaults are slowly rising. Small businesses report tighter credit conditions. Banks are more cautious. Even consumer sentiment surveys show underlying anxiety. Yet unemployment hasn't spiked dramatically. That's what makes this moment unusual. The Fed appears to be walking a razor's edge. If they cut rates too early, inflation could reignite. If they hold rates too long, economic contraction could deepen. Markets are obsessed with reading every word spoken by Jerome Powell. Every speech is dissected. Every policy hint moves billions of dollars. But here's what makes 2026 unique. The Fed doesn't just want lower inflation. It wants inflation expectations anchored. That means convincing businesses and consumers that inflation will stay low long term. The only way to do that is by proving they're willing to keep policy tight, even if growth slows. In other words, credibility matters more than short-term comfort. Some economists argue this is not preparation for a recession, it's preparation for stability. Others argue that the tightening already in place hasn't fully hit the economy yet. Monetary policy works with delays. What the Fed did 12 to 18 months ago is still filtering through the system. If that's true, 2026 could reflect the delayed impact. Another factor complicates the picture: government debt. With federal deficits elevated, higher rates increase interest payments dramatically. A recession could shrink tax revenues while spending raises, worsening fiscal strain. Would the Fed intentionally risk that? Or is it trapped by its own inflation fight? There's also a global angle. Other central banks are facing similar dilemmas. Slower global growth affects U.S. exports. Geopolitical tensions create supply risks. Energy price swings could reignite inflation unexpectedly. This is why markets feel uncertain. The Fed might not be secretly preparing for a recession, but it may be accepting it as collateral damage. And that difference matters, because if recession is a side effect, not the goal, policy could shift quickly at the first signs of serious contraction. But if recession is part of restoring long-term balance, rate cuts may come slower than markets hope. The signs to watch in 2026: sudden unemployment increases, housing price declines, accelerating corporate earnings, collapsing credit market stress, rapid shift in Fed tone. Right now, we are in a fragile equilibrium. No panic. No celebration. Just tension. And historically, tension precedes movement.